Welcome to the deep dive. Today we're getting into the statement of changes in equity. You might know it as the SOCE.
Right.
And it sounds maybe a bit dry, just accounting stuff, but really it's this vital link, isn't it? Connects the income statement right to the balance sheet.
Absolutely. It's crucial because it lays out the whole story, very transparently of how a company's finances have changed.
The evolution, you mean?
Yeah, exactly. From raising capital, managing profits. For you, as someone looking at the company, understanding this helps you see if dividends are sustainable, what the growth prospects really look like. It's fundamental.
Okay, so if you open one up, what are the key bits? You've got
Yeah.
share capital, obviously. That's the money investors put in directly.
Well, straightforward.
But then retained earnings. This one's interesting. It's not just a number, right? It's like all the net income the company has kept and put back into the business over time.
Spot on. It's cumulative.
And there's that formula people see, beginning retained earnings plus the net income for the period minus any dividends paid out. That gives you the ending balance.
Correct.
And here's something to watch. If a company usually pays stable dividends and suddenly they just stop, that can be a bit of a red flag, maybe points to cash flow problems.
Definitely. See, that retained earnings figure, how it moves, it tells you about strategy. Growing retained earnings usually means they're reinvesting, focusing on growth.
Makes sense.
But to get the full story, you really have to look at other comprehensive income, OCI.
OCI, right. What falls in there?
Well, this is where you capture those unrealized gains and losses. Things like, say, changes in the value of certain investments they haven't sold yet, or adjustments from foreign currency translations.
Okay, why separate that out?
Good question. It's to stop those non-cash, sometimes volatile changes from messing up the main earnings figure. It gives you, the analyst or investor, a clearer, sort of smoother picture of the company's underlying value. Ignore OCI, and you could be missing a big piece of the puzzle.
So, speaking of missing pieces, what if the picture isn't just incomplete, but it's wrong or even deliberately misleading? How do analysts catch that?
Well, standard procedures help. Trend analysis on retained earnings, checking the dividend payout ratios over time, things like that can flag anomalies.
But I read about something really interesting, Benford's Law. Seems almost like a statistical trick.
It does sound like it, but it's actually quite powerful. Benford's Law predicts how often certain digits should appear first in naturally occurring data sets.
Like number 1 appears more often than number 9.
Exactly. So you apply this to things like, say, a list of individual cash dividend payments or maybe stock option awards. If the pattern of the first digits looks weird, really different from what Benford predicts, it could suggest someone's just made up the numbers.
Wow, okay. That's for detecting maybe fabricated data. What about more deliberate manipulation?
Yeah. A really high-risk area is misclassifying financial instruments. This is a big one.
How's that?
Imagine something that economically really functions like debt, but the company classifies it on the books as equity.
Why would they do that?
Well, it makes their liabilities look lower than they are. It distorts the whole capital structure, makes them look maybe more solvent, less risky than they truly are. It's definitely something you need to scrutinize carefully.
Okay, so if these kinds of material errors, deliberate or accidental, are found, how do companies fix them? You can't just change last year's report, can you?
Well, you sort of do. It's done through what we call prior period adjustments and retrospective restatements. Basically, you go back and adjust the financial statements from those prior periods as if the error had never happened.
So, like a complex example, maybe a company wrongly expensed a big asset years ago instead of capitalizing it.
Exactly. To fix that now, you'd have to directly adjust the beginning balance of retained earnings in the current period. You calculate the net of tax impact of that error from all those past closed periods and fix it right at the start. It's a major restatement.
That sounds like a lot of work. Better to get it right the first time.
Which brings us to governance, right? How do companies prevent these issues proactively?
Absolutely. Prevention is key. It starts with a strong control environment, that famous tone at the top. Management has to foster integrity, make it clear that things like, say, stock option backdating are just not acceptable.
So culture matters.
Hugely. And then you need practical controls. Segregation of duties is critical. You can't have one person controlling every step of an equity transaction, issuing, recording, reconciling. That separation is vital to reduce fraud risk.
And technology must play a role now, too. Managing this on spreadsheets sounds Risky.
Oh, incredibly risky. Manual spreadsheets are prone to errors, formulas break, data isn't real time. It's a nightmare for complex equity like stock options or cap tables.
So what's the alternative?
Dedicated equity management software. You've probably heard of platforms like Carta, Poly, or ShareWorks. These aren't just spreadsheets, they're specialized
Who
systems.
do they do better? Well, they automate the complex calculations, provide a crystal clear audit trail, keep all the cap table info centralized and accurate, and really help with compliance. Think ASC 718 reporting for stock compensation. It makes the whole process much more robust, much more transparent.
Right, brings it all together.
At the end of the day, the integrity of that statement of changes in equity, it's just fundamental. It's what builds investor confidence. It's a true reflection, or should be, of the company's financial health.
So here's something to think about. Beyond just checking the numbers, what does a really meticulously accurate, transparent statement of changes in equity signal about a company? Maybe about its deeper strategic vision, its commitment to ethics, to playing the long game. Worth considering until our next deep dive.